Good afternoon, everyone. Thank you for joining us for today's YouTube video. Danny Brown, thanks for joining me to talk about some finance here. How are you doing?
I'm doing pretty good.
Great day to talk about some finances, eh?
Oh yeah.
All right, let's get started.
All right. Today we want to look at how fiscal and monetary policy in major European economies, specifically France, Italy, and the UK, affect global financial markets and US multinational corporations. These are some of the largest economies in the world, so policy decisions there don't just stay local, they have global impacts.
Thank you, Danny Brown. Our focus is on France, Italy, and the UK because they're all dealing with rising debt and ongoing budget deficits, but for different reasons. The key question we're answering is how their policy decisions impact global markets and our U.S. firms. Our main argument is that these policies influence global markets through four main channels: interest rates, investor confidence, currency movements, and overall economic growth. Throughout the presentation, we'll show you how each one of these connects back to global financial outcomes.
Stop it for a second. Europe is one of the largest economic regions in the world, with the Eurozone alone representing a significant share of global GDP. It is also a major trading partner of the United States, meaning changes in European economic conditions directly affect U.S. exports and corporate revenues. In addition, European financial markets are highly integrated with global markets, so policy changes in Europe often ripple across the world very quickly.
Thank you for that, Danny Brown. To understand the impact, we first need to look at the core issue, which is debt. All three countries have high debt to GDP ratios and are running persistent deficits, meaning they're spending more than what they bring in. The UK also has additional pressure from Brexit, which has affected trade and long-term growth. Because of all this, investors are increasingly concerned about whether these countries can sustain their debt over time. That concern plays a huge role in how markets react to any policy changes.
This chart shows a comparison of debt to GDP ratios for France, Italy, and the UK. As you can see, all three countries have relatively high levels of debt, but Italy stands out the most at around 140% GDP. France is also elevated at about 110%, while the UK is slightly lower, closer to 100%. These high debt levels are important because they signal how much each country relies on borrowing relative to the size of its economy. The higher the ratio, the more concern there is about long-term debt sustainability. For example, Italy's very high debt makes investors more cautious, often leading them to demand higher interest rates to compensate for risk. France and the UK face similar concerns, but to a slightly lesser extent. Overall, this helps us explain why financial markets closely watch fiscal policy in these countries because high debt levels make them more sensitive to policy changes, and that can quickly impact global markets.
Recent trends. In recent years, European lawmakers have focused on controlling inflation, which led to higher interest rates. At the same time, governments have increased spending in areas like energy, infrastructure, and defense. There's also a strong emphasis on sustainability and environmental policies, which are shaping business strategies and investment decisions globally.
To see how this works in practice, let's look at a real-world example. In 2022, the UK announced a mini budget that included large unfunded tax cuts. This caused a sharp market reaction. Investors lost confidence and the pound fell significantly and bond yields surged. Importantly, this did not just affect the UK. Investors began reallocating capital across global markets, increasing volatility and pushing up yields in other countries, including the US. In contrast, Italy represents a long-term structural risk due to its high debt levels, while France reflects ongoing concerns about fiscal expansion and meeting EU rules. Together, these examples show how different types of policy risk can lead to similar global market impacts.
Fiscal policy refers to government decisions about spending and taxation. Governments can use expansionary fiscal policy, such as increased spending or tax cuts, to stimulate economic growth in the short term. However, this often comes at the cost of higher debt levels. On the other hand, austerity policies aim to reduce deficits, but they can show a slow economic growth. Financial markets closely watch these trade-offs because they affect both economic performance and the long-term stability.
Expansionary fiscal policy occurs when government increase spending or reduce taxes to stimulate economic growth. In Europe, this can lead to higher demand for goods and services, including imports from the United States. As a result, U.S. multinational companies often benefit from increased sales when European countries or when European governments adopt expansionary policies.
Contractionary fiscal policy involves reducing government spending or increasing taxes to control deficits or inflation. While this can stabilize government finances, it often slows economic growth. When Europe experienced slower growth, demand for imported goods declined, which can hurt U.S. companies that rely on the European markets for revenue.
Unlike the United States, Europe consists of multiple countries that coordinate fiscal policies through their European Union. While each country has its own budget, there are shared rules and initiatives that guide spending and deficits. Large EU-wide programs such as infrastructure or energy investments can have significant economic impact across the region and influence global demand.
Monetary policy is controlled by central banks, such as the European Central Bank and the Bank of England. These institutions manage inflation and economic stability by adjusting interest rates and using tools like quantitative easing. In recent years, the primary focus has been on raising interest rates to combat the inflation. These decisions have significant effects on borrowing costs, investments, and overall economic activity.
Policy changes also have a major impact on exchange rates. Fiscal instability and or high debt levels can weaken the country's currency, while higher interest rates may strengthen it in the short term. Fluctuations in the euro and British pound create exchange rate risk for multinational corporations. These changes also affect trade competitiveness as weaker currencies can boost exports but increase import costs.
When the European Central Bank lowers interest rates, borrowing becomes cheaper for business and consumers. This encourages companies to invest and expand, while consumers are more likely to spend. As a result, economic activity tends to increase. Lower rates also push investors to seek higher returns in stock in international markets, which can boost global asset prices.
The exchange rate between the euro and the US dollar is extremely important for global trade. When the euro is strong relative to the dollar, US goods become cheaper for European buyers, which can increase exports. On the other hand, when the euro is weak, US companies earn less when they convert their European revenues back into dollars, which can negatively impact reported profits.
This is a graph from the example of our case study from the UK 2022 mini budget crisis. It shows the rise in cost of borrowing in major economies. It shows the increase in the UK and G7 countries' 30-year bond yields in September of 2022 to October in just a month, the raise in rates that they had.
Central banks like the ESB or ECB and Bank of England control monetary policy. They adjust interest rates and use tools like quantitative easing. Recently, the focus has been on raising rates to control inflation.
This chart shows how aggressive interest rates have increased in recent years. Both the ECB and the Bank of England raised rates rapidly in response to the rising inflation. These increases have made borrowing more expensive for governments, businesses, and consumers. As a result, higher interest rates play a key role in shaping both bond and stock market outcomes, like we'll see in a moment.
Let's start with bond markets. When governments run deficits, they need to borrow more, which means issuing more bonds. This increases the supply of bonds in the market. To attract investors, governments must offer higher yields, which raise borrowing costs. At the same time, if investors perceive higher risk, especially in countries like Italy, they demand a risk premium. This leads to wider yield spreads between safer countries and riskier ones. Because capital moves globally, rising yields in Europe increase borrowing costs worldwide, including the United States.
Stock markets are affected through several key channels. First, higher interest rates reduce stock valuations because future earnings are discounted at such a high rate. Second, policy uncertainty, such as unexpected fiscal decisions, creates volatility as investors quickly adjust their expectations. Third, slower economic growth reduces corporate earnings, which negatively impacts stock prices. Because global markets are highly interconnected, these effects often spill over into the U.S. markets, leading to synchronized movements across each region.
U.S. multinational corporations are directly affected by these developments. First, exchange rate fluctuations can reduce profits when foreign earnings are converted back into dollars. Second, weaker economic growth in Europe reduces demand for U.S. goods and services. Third, higher global interest rates increase the cost of capital, making it more expensive for firms to invest and expand. Companies may also need to adjust their supply chains in response to charging economic conditions.
U.S. multinational corporations operate in many countries around the world, and Europe is one of the most important markets. These companies rely on international sales, supply chains, and investments. Because of this global presence, they're highly sensitive to this economic conditions, exchange rates, and policy changes that are being happening in Europe.
The strength of the European economy directly affects the revenues of U.S. multinational corporations. When Europe is growing, consumers and businesses spend more, which increases demand for U.S. products. However, during economic downturns or recessions, demand falls, leading to lower sales and reduced revenues for these companies.
Currency fluctuations play a major role in multinational financial performance. U.S. companies must convert foreign earnings into dollars for reporting purposes. If the euro weakens, those earnings translate into fewer dollars, reducing reported profits. If the euro strengthens, the opposite occurs, boosting reported income even if actual sales remain unchanged. We're going to take a look here at a great example that shows what happens when the markets are down in the UK, like happened in 2020, 22, how we mentioned earlier in the crisis and how that affected the US. So let's take a look at that.
Let's talk markets, inflation, the Fed. Cameron Dawson's here, Chief Investment Officer of New Edge Wealth. Good morning to you. We're all trying to make sense of what we're seeing out of Europe this morning, what the impact of these European banks are going to mean, and as we were just discussing, what that therefore means to the Federal Reserve and our own markets, and you're seeing a key off of it. But what's your take?
Yeah, clearly there's now a shift back to this risk off tone with rising risk of the banking sector, not just in the US, but now also in Europe. But we're really not certain that that would change the Fed's course, mostly for next week's meeting, just because of that hot CPI print and really that core, super core services CPI that really accelerated yesterday. And so I think that that keeps the Fed engaged in the inflation fight. And it doesn't necessarily mean that the Fed's going to pause in May as well, because if we think of when the May meeting comes, it's at the very beginning of the month, which means that they'll only have March data to make their decision. So unless we have another banking issue within the US, it could mean that we still have further rate hikes ahead.
When you look, though, at what Jay Powell has to do and how he has to consider or not, this was the discussion, how much does he have to consider what's happening now in the European markets?
Yeah, well, the problem is we've seen Powell, or we've seen the Fed pivot for a lot less. We've seen the Fed pivot in 2018 because of short-term funding markets, 2016 oil and gas banks, go back to 1998 with LTCM. Arguably, the size of SVB, as well as what's possibly happening or brewing within Europe, would have normally argued for the Fed backing off. But the difference today is that inflation is still very hot. So to Melissa's point, as you're balancing this trade-off between financial stability and price stability, the challenge you have is that they haven't had to focus on price stability in the past times that they've pivoted. And so that likely means that the Fed is caught in this corner of having to choose between the two, which just means that there's still very great uncertainty about the policy path ahead.
Because financial markets are globally integrated, these effects quickly spread to the United States. Instability in European markets can lead to capital flows into or out of U.S. assets, influencing stock prices and bond yields. It can also affect investor sentiment, increasing volatility in U.S. markets. In some cases, the Federal Reserve may even take global conditions into account when making policy decisions.
Key takeaways. European monetary policy, especially interest rates set by the ECB, affect the global financial conditions and investment flows. Fiscal policy influences economic growth and demand. Exchange rates are critical for international trade and corporate earnings. Overall, U.S. multinational corporations are significantly impacted by the changes in European policy, making this an important area to be understood in global finance.
In conclusion, fiscal and monetary policy changes in Europe have significant global ripple effects. They influence interest rates, financial markets, and economic growth, and directly impact U.S. multinational corporations. Understanding these connections is critical for investors, policymakers, and businesses operating in a global economy. Thank you.
Thank you very much, everyone.